Have you ever wondered why the rich get richer and others don't? Could it be that a small percentage of the population seek out others to find, study, and execute on legal loopholes that exist within our financial life and make it easier for them to prosper? The answer is a resounding yes. This is the Secrets of the Wealthy podcast with John Mintz. John has spent a lifetime researching and mastering the financial loopholes that he believes should be available to everyone. Join us as we explore different strategies that help you get farther faster towards building and enjoying a prosperous retirement.
Hello and welcome to the Secrets of the Wealthy with John Mintz. John, how are you today?
Hey, Eric, doing great. I can't believe that we're already on our 19th episode. When you're younger and your folks or your grandfolks, they tell you that when you get older, time is going to go faster, and you just don't believe them. But here we are, and it does seem to go faster, doesn't it?
Oh, all the time. And seriously, we're two old guys talking on a park bench for crying out loud at this point. We're at episode 19. Man, this is just, it seriously is flying by, and I'm loving it. This is a lot of fun.
Yeah. And just as a reminder, our vision is to help bring the so-called secrets of the wealthy, that's the name, right? Secrets of the wealthy to the masses so that they no longer need to be secrets.
Yeah.
And everyone can potentially benefit as well, right?
Well, I mean, it's incredibly important right now. You see the division in the country, and we're not going to talk politics, but you see the division financially in the country, and you have all these people that just don't understand, how am I possibly going to afford a home one day? How am I possibly going to be able to do A, B, and C? And it is very disheartening to see that. And as someone with children, and you have children, you want the best for your kids, and you don't want there to be this gap. And I love this podcast for this exact reason. You're telling these strategies so that you kind of level the playing field, really.
Yeah, and we're going to talk about interest rates today, in particular rising interest rates, and what impact that is going to have on us, how we can prepare for it, and more importantly, how we can protect ourselves from it. I did this last episode is tell everybody what the date is today, and I want to do it again. Today is March the 7th as we're recording this, and I think this is going to be released online on I think March 16th, and you're going to find out in a minute why that's really an important date as it relates to this podcast we're doing. But just to give everybody an update from last time, the last one we did was February 11th. And at that time, the S&P 500 was 44.18. Today, it's 42.50. Oil was at $92 a barrel that day. Today, I think it hit 120.
Oh, my gosh.
And so, the things that I was worried about and concerned about and telling everybody about last time, they seem to, unfortunately, continue to happen. And so it's interesting. That's why I try to log the date, and so everybody kind of puts things in perspective. So anyway, let's go back in time a bit to 1981. So let's have some fun with this, Eric. How old were you? Where were you? What were you doing in 1981?
All right. I was 7 years old, my man. And I was, so I would have been in Puyallup, Washington. And I was probably digging in the dirt on the side of my house, building all sorts of roads and doing a little mini construction for all my Matchbox cars with a neighbor friend of mine.
Oh, there you go. Did you have the Tonka trucks too?
Oh, not the big ones. I had all the little small ones, so it was just like its own little construction site, and there was always one guy that just drove like crazy, of course, and crashed every time.
Yeah.
That's how it works. So where were you at?
Well, I was a junior in high school at Sweetwater High School, Sweetwater, Texas. The only thing it's known for is the world's largest rattlesnake roundup, whatever that is.
Oh yeah,
but. Yeah, people come from all over the world for that thing. But my father was actually, he had retired from the ministry and was a shop teacher at the local school with 5 kids, and of course we didn't have a lot of money. And so I guess I didn't really remember that was such a difficult time economically, just because we didn't have a whole lot anyway. So yeah, but I just remember it being generally speaking, things were just difficult. But a few fun facts about that time. The number one song back then, you probably wouldn't remember it. I didn't remember it. I remember it when I read it. But the number one song was Betty Davis' Eyes by Kim Carnes.
Ah, yes. Classic.
And the number two song was Endless Love. So
yep.
That right there tells you it was a different time. The number one movie, it was a Harrison Ford movie. Do you remember what it was?
In 81? With Harrison Ford. Would that have been like the third Star Wars?
Oh, no, but along those lines, Raiders of the Lost Ark.
Okay, all right. So Star Wars must have been a few years. Maybe they ended up in the 70s.
Yeah, probably. So that's some fun facts. Now let's talk about some not so fun facts. It was the last time inflation was at or above 7%. And that's been 40 years since then. And, of course, we know it's above 7% as well. The new CPI data comes out in a few days, and everyone's waited with bated breath, but I don't think it's going to be good. You'll understand in a minute why. Gas is now $4 a gallon. $4 a gallon is the national average today for gas, which is 10 cents away from the record high of all times. The average went up 9 cents since Saturday. I'm not counting today, okay? And 47 cents since Russia invaded. So in 1980, crude oil was $134 a barrel. In 2008, it's $179. 2 weeks ago, it was $92. Today, it's at $120. So, similar to the early 1980s, we had high today. We have high, or what some people would start to calling hyperinflation. We had crude oil above $115 and climbing. So what's missing? What did we have in 1980 that we don't have today yet? And that's high interest rates. In 1981, interest rates reached a modern day high, an annual average of 16.63%.
Wow.
Yeah.
Seriously?
16, yeah. Well, in June of that year, it actually reached 18%. Now, I started working in the field in the late 80s, in the mortgage field, actually. And I remember them being double digits at that time. But, I remember a lot of folks I worked for that told me about mortgage rates reaching 18%. And here you have it. Yeah,
I can't imagine
again,
that.
the average that year was 16.6.
Jeez, I can't imagine that. I cannot imagine being a shopper back then, trying to buy a home and looking at those numbers. That's insane.
Can you imagine what it would be to try to buy, well, even a $300,000 house today with that kind of interest rate?
Wow.
So here's what I didn't know. When I started doing a little research for this podcast today, this one just shocked to me. I didn't know. I didn't see it happening. But today's national average rate on a 30-year fixed, we're talking about 30-year fixed rates, is 4.21%. Now, in November of this past year, so what is that, 3 months, 4 months ago, it was 2.53. So the national average has gone from 2.5 to 4.25, and the Fed hasn't even raised rates yet.
So why did it change? If the Fed hasn't raised rates, why did it change?
Well, the only thing I can give you is the markets are adjusting themselves in advance of what they know is coming.
Yeah, got it.
That's the only thing I
kind of like a precursor.
Yeah, which is what the markets do to a great extent as well. So, but the point is, rates have climbed almost 2%, and the Fed hasn't started raising rates yet. Now, knowing that the Fed has announced that they will most likely raise rates, well, at least 7 times in the next 12 months, beginning as soon as March 15th, 16th. So the Fed meets again the middle of this month. and that's why I said that date of March 16th was a key day, because they usually announce whether they're going to increase rates or not at the end of their meetings. And that's the day this podcast is going to most likely be posted. But it's going to be interesting to see what happens next, right? And so everyone believes that they can't get away without increasing rates at least by a quarter. I don't think they're going to be able to go a half with everything that's happening, geopolitical in the world right now. That's already having a negative impact on the markets. But so let's just assume that logically their rates have to increase based on what we've talked about, right? Both on this podcast and the previous podcast. Let's just talk about what typically happens when rates start to rise, all right? So, wherever the rubber meets the road, we talked about, you said, I can't imagine shopping for a home with those kind of interest rates. Well, let's just look how a 1% increase in the federal funds rate and how that might impact the lifetime cost of a home mortgage loan, all right? So you take a family shopping around for a $300,000 30-year fixed rate mortgage. And $300,000, depending on where you live, doesn't buy a lot anymore. But let's just use that number. Certainly, this won't apply if you're listening in California or New York. You have to double that number.
At least, yeah.
At least. But if banks were offering them an interest rate of 3.5%, the total lifetime cost of that mortgage would be roughly $485,000, with nearly $185,000 of that accounting for interest charges on top of the principal, right? And the monthly payments would clock in around $1,340. So $185,000 in interest, $1,340 in payments, all right? Not counting taxes, insurance, all that other good stuff. So a 1% increase, that interest charges go from $185,000 to $247,000, and their payment goes from $1,340 to $1,520.
With 1% change?
With a 1% change.
Whew.
And we've increased almost 2 since November. So logically, what's that going to do to things around us? Well, I guess people stop buying houses, right?
Well, I mean, it's no, they have to. I mean, they have to buy houses, but now they can't afford the other things, right? I mean, I think you roughly said their mortgage is going up by $200 a month, right? So that's $200 a month that's not being used someplace else. That's how I look at it. Maybe that's just a different way, but I look at it as that's $200 worth of going out to eat, or adding a little something here or there to the house, meaning knickknacks and whatever. That's a dent.
Yeah. No, you're right. I was being sarcastic, but you're right. If the individuals have to buy, if they have to buy a house, they have to buy a house, right? And so they're going to have to cut back in other areas. And that's just this was a very, the example I just used was a very simplified example, but it shows how the Fed reduces the amount of money in the economy when it raises rates, right? So it also has an impact on stocks historically, because higher market rates, they have a negative impact typically on the stock market. Like last time that happened was 2018 was the last time we had a negative year, because when the Fed rate hikes, when they start to hike rates, it makes borrowing money more expensive for everyone, and the cost of doing business rises for both public and private companies. So if the cost of borrowing money from a bank increases, then their opportunity to expand investment in capital goods, also stalls. So, the interest rate may be so high that many companies just won't be able to afford to grow, right? Then, of course, there's just a general market psychology that, when the Fed starts to raise rates, the traders might, sell off stocks and move into more defensive investments and other types of investments in general. And then lastly is the impact on bonds, because bonds, as we know, are sensitive to interest rate changes. And when the Fed raises rates, then the market prices of existing bonds immediately decline, and that's why new bonds, coming into the market are offering higher rates, which make the existing bonds very unattractive, and they decline in price, right? So, it's like a domino effect.
Yeah.
And we're just talking about 0.25% or 0.5%, but if we get another 2% over, the next year or two, some things are going to change, right?
Yeah. Yeah. My goodness. Going back, you said that the interest rates at one point back in 81 you said the average was like 16.2%, right?
Yeah, 16.6.
16.6. I used the wrong calculation. I used 16.2. That same $300,000 house ends up being $1.469 million over 30 years. I don't understand how anybody can afford something like that. Now, I mean, that's the extreme, right? I mean, that's not what we're talking about here, but you're even saying 2% difference in the next couple of years. Beyond that 1%, that's another $400 out of somebody's budget, $500 out of somebody's budget per month that has to go toward that house that shouldn't cost that much. I don't know. That's a little frustrating to me.
Yeah. Well, wait till it happens to see how frustrating it is for everyone.
True. Yeah.
It is frustrating, but it is the only tool that the Fed has left to slow down this runaway inflation freight train.
Yeah.
It's out of control. There are individuals now that believe, because of what's going on, in our world right now, that crude oil is going to hit $200 a barrel. 200.
Yeah. Yeah. I mean, you said earlier, markets react to what might be. Right. I mean, that's what's happening now. You said the interest rate has gone up a little bit and I asked you why, and you said because they're probably looking to what's going to happen. And so that's kind of the market is adjusting based on what could possibly happen. And now we look around the world at what could possibly, quote unquote, happen, especially with oil, Russia, Ukraine, all these different countries that are, I mean, it's just, so I absolutely agree with you. We could definitely see that price. And that's, again, I mean, the one silver lining is that tons of us don't have to commute anymore, right? Because of COVID. I mean, right? I mean, so the gas prices aren't going to affect us as much. But I'll tell you, this last year, John, I bought a truck, and because we're doing work on our house, and again, lumber went up, and all these things, all these different prices. But just lately, in the last month or two, I looked at my truck and I was like, I might take my wife's car. I love my truck, but 11.8 miles to the gallon, it's got a Hemi and it's fun, but it's costing a bit more now.
Yeah. And I hope it wasn't a diesel truck.
Not a diesel. No. Yeah.
Yeah. It's interesting that you bring that up, though, because these are kind of daily decisions that people have to start making, right? Mm-hmm. Do I now have to group my errands, right? I can't just run to the grocery store.
Right.
If I got to go to the grocery store, I may go to the grocery store and the dry cleaners and the, whatever else I've got to do while I'm out, because it might save me, $4 or $5 if I do it.
Yeah. Right.
And these are things that we did back in the 70s and 80s for the same reason. So, it's interesting. The Fed has backed itself into a corner. It really has. They tried to be proactive with this in 2018, and they chickened out. And now they don't have a choice. I mean, if oil does go to $200 a barrel, and now we have gas prices instead of $4, maybe $6 a gallon, which has an impact on even more dramatic impact on inflation. Mm-hmm. Then they've got to raise rates even more, right?
Yep.
So. Yeah, it's not a good situation, but there are some things that we can do to protect ourselves, and that's something that I've really started talking to individuals about. Is you need to be speaking to someone that can help you learn how to protect yourselves against these kinds of things that not just are happening, but let's get out ahead of this stuff. And look at what's coming. Let's lose logic and see what's coming, and let's do some things to protect ourselves against these things that are coming.
Yeah. Well, that was actually my next question, because the people that I think about, quite honestly, are my parents. Right? They're on a fixed income, they're retired, and it's not like they can go out and get a new job. It's just not going to be possible for either one of them to go and get a job to make that extra money. I could do that. If I had to work nights doing something, I could to supplement my income. And there's lots of places hiring, so that's not as big of an issue for me. So how do you help like people that are just getting ready to retire, pre-retirees? They're looking 5 years down the road, and all of a sudden, what they thought about 2 years ago, as far as what their budget on a monthly basis was going to be, that's kind of being blown out of the water with the price of gas increasing and the price of meat. I mean, I'm not a vegetarian, my friend. I don't want to slow down eating meat, but doggone it, those are some of those decisions I make at the grocery store now. I'm like, I could get those steaks for this weekend. I want to do steak fajitas, or we could have hamburgers. And I'm still buying beef, but it's just not the same, right? So how do you help people guard against this stuff?
Well, I think it really comes down, especially for retarees, and you mentioned your folks, but I think especially for retirees, I think it's a matter of protection right now. The old saying when we get in times like these is the old saying is cash is king, right? And so if there's ways that we can do analysis for folks and show them what their exposure is to the stock market, show them what their exposure is to the bond market for the reasons we mentioned earlier, and how you can protect against both of those if we go into a more volatile, I can't imagine it being even more volatile than it is right now, but if we go into more volatile times, and as a result of increasing rates, just make sure folks are protected. And the reason they need to be protected is because if they do have to go from taking a draw on their retirement funds, where before they were taking a draw of, let's say, $1,000 a month off their retirement funds, and now they need $1,400 a month, right? Well, somebody has to have looked at that for them to make sure, they're able to do that and not run out of money.
Yeah.
Before they run out, right? So if they haven't had an analysis like that done, I think it's really important for them to do that. And making sure that the assets that they do have, let's just say that they would have had enough money, even by taking a larger monthly draw, as long as what they have is protected. And that's where I take great pride in what we do, is showing folks how they can put some protective barriers around what they have, especially if they're home free the rest of the way, even in spite of inflationary pressures. I take a lot of pride in help showing folks how they can achieve that and giving them peace of mind, for sure.
Yeah. So how do people get that? I mean, you're talking about the analysis that you do, correct?
Yeah. And so, at the bottom of the podcast, we're going to put a link as to that people can click on that will direct them directly to us through our website and show them how they can get these types of analysis done. And in most cases, we can do it. They can come by and we can talk and we can do an analysis for them that way, or it can be done virtually as well. So it's very, very simple. It takes literally minutes to do these types of analysis. Very simple.
All right. So let me ask you this. We were talking about retirees and a little bit about pre-retirees. The analysis that you're talking about, who is this going to benefit? Is this for any age? Or are you talking that this is really somebody that's in that later stage, 5-10 years before retirement?
Well, I have the belief that protection is a good thing for everyone if you don't like to lose.
That's a good way to put it. Yeah.
Yeah. Well, I mean, if you're the type of person that, like when I go to Vegas, for example, I don't like to lose, and I don't go very often because I don't like to lose. But when I go, I'm extremely disciplined. I play one game, and that's blackjack because it's the highest odds. I have a daily limit that I bet, no more, no less. If I double that limit, even if it's in 5 minutes, I stop. If I lose that limit, even if it's 5 minutes, I stop. And then I go watch shows or whatever else I do. So I'm really, really disciplined because I don't like losing. In most cases, I come out ahead because of that discipline. And so I don't care if you're 27 or 67. If you don't like to lose, now's the time to be thinking about protection. So, and I have clients that range from both of those dates and everything in between. And I reached out to them, over the past month to let them know what I see, and they don't see anything differently because of the types of people that they are, which are, they like to win and don't like to lose. So, yeah, I think everybody can certainly benefit, but our primary focus is on the individuals, like you're talking about with your folks, that they don't have the opportunity to go make more money or contribute more to their retirement. They've got to really, really be zeroed in on protecting what they have the rest of the way.
Got it. All right. Well, John, I appreciate your time. Any closing thoughts for today's podcast before we wrap up?
No. I encourage everyone, as I always do, that you really, 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 now's the time more than ever to be thinking about what's going on around you and how to protect yourself from it. And glad that we could have this show again today.
No, me too, John. Thank you so much for your time.
You too, my friend.
You bet. And listening audience, before I close this out, just one more note. The link to his website is going to be in the show notes. So just go to the show notes on whatever podcast player you're using, and you'll find it. It's actually a link, so you can just click on it, push it with your finger, whatever. It'll get you there, and you get more information that way. It's fantastic. Him and his team are just absolutely dedicated to the people they serve, and it's my honor to be on this podcast with them. So please go check that out. And of course, we just want to thank you for tuning in and listening to the Secrets of the Wealthy podcast with John Mintz. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share this podcast with your friends and family. And again, I'd love for you to do that. If you know somebody that could use that assessment, send this to them. They're gonna hear it, they're gonna click it, and they're gonna get to know John and his team and what they do, and they're gonna thank you for it. Again, thank you so much for listening today. For everyone at the Secrets of the Wealthy, this is Eric Johnson reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Secrets of the Wealthy podcast with John Mintz. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of John Mintz. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.